Good morning, good evening, good night from wherever it is that you're watching us all across the world. My name is Richard Estanjao, Head of Digital and AI Integration at Faida Investment Bank, specifically for the Oak Special Fund. And with me, I've got none other than the Director Operations, Faida Investment Bank. And I'm so excited because we're going to be having such an amazing, educative conversation today with none other than one of the most, what's the word to describe this brain cells that you have there? with one of the authorities when it comes to the financial world. Not just authority from the sake that she talks it, but she's a practitioner. So Reena, I may not be doing justice to you, so I'm going to let you holistically introduce yourself to the viewers that are watching us today.
Okay, thank you so much, Richie. Thank you guys for watching and being with us. My name is Reena Hicks, and I am the Operations Director at Faida Investment Bank. And part of what I do is help companies raise capital. So I also lead the corporate finance department at Faida. What we do is help companies raise capital and also create instruments or products that people can invest in through raising capital for those companies, and also oversee the Oak Special Fund team, of course, along with Ian Kangara, who's our Global Markets Director.
Yep. So I said you have to do justice when it comes to your introduction.
Oh yeah, so I forgot actually. I'm like, okay, I've spoken for long on the introduction. I'm also a very, very passionate person when it comes to personal finance. I founded the company RH Group, which handles the brand MoneyWise. And the brand MoneyWise basically helps with coaching, training, content creation around personal financial management and helping people become financially free. And that's what we do.
I love it. So the reason why I decided that we needed to have this education video conversation before 2026, the date today is the 9th of December. I call this No Man's Day.
I know, it's like, what day is it? Is it Monday? Is it Tuesday?
Yeah. So today is the 29th of December. I'm not sure whenever it is that you may be watching this, but I wanted us to have this conversation before we get into 2026. And a lot of people watching you on this channel being Oak Special Fund, and we're shooting this. By the way, first and foremost, congratulations.
Thank you.
We are shooting this at the new Oak offices.
So excited. It's very
so excited. Yeah, just excited. Yeah. Let there be the movement of progress.
Yeah, we still have the contractor on site, but we're not yet done. But we've moved in. We're now at 9 Riverside Drive on 4th floor.
I love it. Yeah. So, and we're going to be shooting a whole video to show this whole place later on in next month. Let's just say that. In 2026. So anyway, so the reason why I wanted us to have this conversation, a lot of the times when we are watching you and Ian seated here having a conversation, it is normally the quarterly fact sheet fund reports that you are doing. However, because I have the privilege of knowing the other hats that you wear and the skill that you possess in these things, for example, personal finance. You have walked people through debt, getting out of debt. Yeah. You've helped people manage their finances. You've actually explained to people what it is that you may have done when it comes to personal finance.
Yeah. I think it's been an interesting journey. I think the reason I'm so passionate about personal finance, Richie, is because I've made horrible decisions myself. Horrible. And I think really God created me to just teach. I call myself an exhorter. When I learn something, I want the whole world to know they don't need to go through this stress. This is how it works. This is what needs to be done. And so when it comes to personal finance, I've made horrible mistakes. And through the journey, I've found that I've learned certain things. And as I'm learning, I like to take others along with me. And that's what drove me to, first of all, write a book. And wrote the book, MoneyWise, Create, Grow, and Preserve Wealth. So I'm also an author. But through writing that book, I realized, I need to sell this book. How will I sell it? And then began to create content through For Up Digital, where I first met you. And did that for a while. And then when the videos were out, guys would be like, oh, can you come and train our staff? Oh, can you come to my chama? Can you come? So initially did a lot of that. where I do lots of trainings and speaking engagements.
And those trainings and speaking engagements, they were with individuals,
Yes.
they were with institutions,
Yes.
they were with, I'm even heard you say chamas.
Yeah.
Okay, so it's not just one-on-one.
No, so in fact, at that time, it wasn't just one-on-one. It was mostly, sort of speaking engagements that were general. But then I found that a lot of people would come and say, can you coach me? And I'm like, coach? What does that even look like? I don't even have the tools to do that. So I went back to school and did a coaching program with CDI Africa.
Wow.
Finally finished and became a certified coach with the International Coaching Federation. So I'm a certified coach as well.
Whoa, okay.
Yeah, so I do take one-on-ones, but very few. And the reason I take them is because I feel so privileged to be able to walk a journey with somebody. And it helps me learn so much. It puts me in a place where, sometimes you can just live your own life and you don't understand what else is out there. But I learn so much from my clients. I grow as well as an individual because there's so many brilliant people out there, by the way. But at the same time, it gives me such joy to be able to move somebody from A to X, in their journey. And it's just so fulfilling. So I love it.
And I love that. One of the people who you've actually worked with, Larry Lisa, was on this platform talking about how he would meet with you on a regular basis and how you helped him grow from this point to this point. In some of your videos, I've had you explain about people who've maybe been in debt and have come to you and you've had the opportunity to walk them from here to here. You, on a personal level, you're holding me accountable on the financial goals that I've set. And I'm just like, oh, shucks, here comes that phone call. Is this my boss calling? Is this my financial coach calling? But, so the reason why I wanted us to do this video is to help our Oak clients. A lot of times when I'm having conversations with people about Oak, the question is, what's the return like? After I tell them the return, it's like there's no other conversation. I'm talking about potential people joining and people who've joined. And I'm just like, wow, when I had that conversation with Reena, it didn't just end at return. You asked me, what are your goals? What are this, that, the other? Have you thought of this? Maybe Oak may not be the right place for you to invest. Or how about you diversify your investment? Put some here, put some this. It's 2026. I'd like us to share some of these amazing nuggets that you have when it comes to investing so that you can help our clients, and not just our clients, because these videos will be even watched by other people, just have an understanding on how to approach investing. So that's why I have called you on the 28th on No Man's Day. 29th. Yeah, I'm sorry, it's No Man's Day.
But it is well.
Okay.
Yeah.
So, intro, I hope now you've understood why we're having this conversation. So let's kick it off by asking, when it comes to investing, where do we start with this?
I think the first thing people need to ask themselves is, what do I want? Where am I going? I guess which is what you were talking about, the goals. I have 100,000, where do I invest? Is usually the question. Or I have 10,000, where do I invest? Whatever the amount, what do I do with it? And I found a hack some years back. And this hack is just so simple. And it uses Maslow's hierarchy of needs. Okay, so this gentleman called Ashwin Chabra was a lecturer at, I think it's Yale University. And he sort of just, I did finance in school, and so we did asset allocation, and he then comes up with an alternative asset allocation model that I thought was just brilliant. So that's what I use. And so the model is based on Maslow's hierarchy of needs. We've all done, as long as you've been to school, to at least high school level, you've seen this triangle. And at the bottom of the triangle is physiological needs. Your need for safety, your need for security, your need for food, right? You need to eat, you need to sleep, you need, these days, things like Wi-Fi and education are basic needs. So you want to make sure that your assets do three things. And I'll use the pyramid to explain the three things. The first, which is at the bottom, is to make sure that your basic needs are constantly taken care of. And the idea is that if my salary doesn't come through, if Kenya is bombed on one corner, God forbid, or COVID happens and I can't work for 6 months, that my basic needs are catered for. I can pay rent, I can pay power, I can pay for my children's school fees. Those basic things are taken care of. Your assets must do at least that. The second thing your assets must do for you is make sure that you're able to sustain your current standard of living, both now and for the foreseeable future. Okay, so what does that even mean? So, right now, I go to the salon maybe. Perhaps I play a sport in a certain place, or I go to the gym. Maybe I like to hang out with my friends every Saturday at a certain place and we have a certain meal. Or maybe once a year I go to the village during Christmas and enjoy my time. And I want to be able to continue to do those things. Because what's the need that's satisfying? The psychological needs. That's usually in the middle part of the pyramid. Psychological needs. Your need for belonging, your need for love, your need for being able to socialize with others and feeling like, yeah, life is worth living because I'm able to enjoy life at a basic level. Now, in order for you to continue to enjoy your standard of living now and for the foreseeable future, your money has to grow alongside you. What do I mean? I used to love Java chicken pies. When I remember, I used to buy Java chicken pie for 180 bob. I haven't bought one in a while, but I think the last time I bought one, it was like either 240 or 330. I can't remember. But you can see the increase in price, right? Yep. So there's something called inflation, where there's a general rise in prices of goods and services. Perhaps you used to get your haircut as a boy with your dad at 60 bob. Yep. Right now, it's 500.
If you include massage.
If it's a massage, it's 1,000. Now, are you telling me if you have your money sitting in a current account, earning you zero, you will not be able to even have a haircut in 5 years because your money is losing value from a purchasing power perspective because of inflation. So I have to invest my money so that it grows alongside me, even as I continue to work, so that then I can afford to pay for the education for my children. I can afford to do the different things that I need to be able to do. So you must invest. It doesn't matter whether you are what or don't have. You have to find ways, where am I going to find an income to invest so that I can be able to afford to do the things that I need to do later. Just basic things that I'm doing right now, whether it's paying my rent or,
Can I slow you down?
Oh, okay.
I love what you're saying. It's just that I want to make sure we are all together. What I'm hearing you say is, first and foremost, there has to be some sort of income that is coming your way.
Yeah.
By the time you're talking about this pyramid, this pyramid is where you take a portion of your income to then the order in which what needs to be fulfilled by the investment. So for example, if I'm earning 100,000, you're saying I need to first and foremost take a portion of that income, let's even give an example, 20,000, and put it into a place where, if or not I have this income, I have food. That was the first element of the pyramid. Am I right?
Yes.
So then the second one is now where you can be like, there's some things that I liked in my life. So still from an income, whether that income is a salary, whether that income is from consulting, it's regular or not, investment is taken from active income or from another sort of income to create a sort of passive income. Am I right?
Yes.
Okay, I just wanted to make sure that people have understood that income is not even, we're not even talking about that.
No, that's a given. You have to have an income.
Yes.
As soon as you graduate, as soon as you finish school, if you're going to a technical school, as soon as you get to 18 years, please look for an income. As soon as you can. Even at 15, if you can find a way to earn an income, that's the first thing you need to figure out. How can I earn an income? Because it's from your income, then you invest. Even if the income comes once in 3 months, you need that money to be able to put aside so that your assets do 3 things. We've talked about 2.
And again, to interject and just make you understand, bring this back to Oak, we do have Oak clients who are in university.
Yes, we do.
Yeah, okay. So this is not limited to investment
No.
at 80 or 50. Okay.
This is for everybody.
So first one again was?
Your basic needs.
Basic needs?
Yeah.
Second one?
The second one is your psychological needs. Okay. Yeah, your need for belonging. Your need to be able to meet your current standard of, no, rather, to meet your current standard of living for the foreseeable future. So that then you're not taking your children to a certain school. 5 years from now, things happen, and then you have to move them to a different kind of school. Or you have to move from where you're living, maybe a 3-bedroom apartment, you have to move to a bed-sitter because you're not able to sustain your current standard of living.
Okay.
The third thing your assets must do for you is give you an opportunity to create wealth.
Oh.
Yeah.
Okay.
Because I strongly believe that we all of us, have a reason that we were created and a reason that we are here. We are here for impact. And all of us are impact in different ways. We're here also to enjoy life, right? Mm-hmm. And you need a level of wealth to be able to impact and to enjoy life. We can't just be at the basic level from the day we're born to the day we die. I don't believe that. I think that we all should get to the level where we enjoy a certain level of wealth. And of course, that will look different for different people, right? So what is wealth for me might be something that is nonsensical for someone else, okay? So
we don't all have to drive Bugattis.
Exactly, we're not all looking to drive Bugattis, okay? So I think the point is, what do we need to do to be able to meet some of the desires that we have? So, for example, I've met people who want to plant 1 million trees. I've met others who want to educate the whole, 100,000 children from their village. There are others who want to give to the church or give to ministry that is doing something meaningful, and they want to give a certain amount of money and things like that. There's different passions and pursuits that we all want, or we all have. And so for you to do that, you need a level of wealth. So the third thing your assets must do for you is give you an opportunity to create wealth.
I get that.
So now let's go back a little bit. What are we trying to do? At the bottom, where we're talking about basic needs, there is a risk that you need to be aware of. And that's your personal risk. Risk of health, risk of an accident, risk of salary not coming, personal risk. At the next level, it's market risk. Markets go up and down. Then there's inflation in the market. So I need to make sure that I invest to protect myself from markets going up and down, but also from inflation. But then at the next level, I want to make sure that I give myself the opportunity to make good money. 20%, no, what am I saying? Like double my money in 2 years, right? Where can I invest my money so I double my money in 2 years? So things like, now let's go into examples of where can we invest the money.
Okay, I like this. So depending on all these different factors, the investments change. The investment options change.
Yeah.
Okay.
So depending on what we're dealing with, what is the goal or what's the need, your investment choice will be determined by the need. So I met somebody, we were being interviewed, I could forget the station, and there was a gentleman who came to give a testimony about how he had really made a horrible decision. He had saved 4 million shillings. He had done really, really well, and he had saved 4 million shillings, and his friend whispered to him about a certain SACCO that the guy was making, I can't remember now, it was like 20% return every few months. So it was like a really high return. And this gentleman was like, oh my gosh, when he did the math, back of the envelope, he's like, oh my gosh, he put all his 4 million into this thing. Unfortunately, like a year and a half later, he was part of the people on Kiambu Road queuing at DCI.
Wow.
To make a report about this certain SACCO that went under, and he lost all his money. So that's why we have those 3 baskets, or those 3 ways of investing, because you can't put all your eggs in one basket. It doesn't matter. Life happens. COVID can come and wipe things out, and your whole business can crumble. I mean, there's countries like South Africa where I think it was for 600 days there was a lockdown, and businesses went under. And so you have to find a way to invest your money so that then when things don't work out, you have some money available. Okay, so security basket. Okay. What are we talking about there? It's, for example, you need to have a pension. I need insurance for healthcare. It's not an investment, but it's a risk management tool, and it is extremely important.
Wow.
I need to make sure I have insurance for my life, especially if I'm a single parent or a single earning person, or me in my family. If I don't have an income, it significantly affects the stability of my family. I need to have some kind of life insurance, Or I could decide, you know what, let me get an education policy if you want to go that way. But life insurance is good enough. You can decide I'll get life insurance that then sorts out my family should things not go well. All those things are security basket. Emergency fund. So if you save money in a money market fund for emergencies, that's in your security basket. You decide I'm a professional in HR and I want to get another course to give me either job security or give me an opportunity to get a higher position or higher pay. That's in your security basket. It's an investment in your personal development.
This is so good.
Yeah.
Makes sense. Yeah.
So that's there.
Yeah.
That's physiological needs. We are still down here.
Still.
So now what you find, guys say, me, I've invested 10 million. In fact, all the money I have is probably maybe a 30-year-old. I have 10 million in my money market fund. Oh, money market. Okay, great, but 8-10%, it doesn't get you there because it's
your security is sorted.
Your security is sorted, but you need to do more.
Yes, I get what you mean.
So shall we go to the next level?
Wait, I've had this from individuals. As companies, as corporates, beyond individuals, is there a way that they should also invest in security funds?
As corporate, yeah. So you mean as a company, as a business?
Yes.
Yes. So as a business,
again, I'm asking this with the understanding that Oak Special Fund has got individual accounts,
yes,
joint accounts, so that's family or even with siblings or whatever it may be. It's got corporate accounts.
Yes, we do.
So they, as a corporate, how does the security fund look for me?
So as a corporate, you want to have cash that is available to you for your day-to-day running. And sometimes you have reserves, right? You have some excess cash. You don't want to just have that cash in a current account. You can decide, okay, I can put this money away for a month, or I can put this money away for a year. And so how can I maximize my year from a return perspective, but also make sure it's safe? So you could decide, you know what, let me put it in a treasury bill. Treasury bill, by the way, is also security basket. Okay. I can put it in a treasury bill. In 3 months, I'll get my money back. Or you could decide, let me sign up for what we call a call deposit with a bank. And the call deposit is where you sign up for an account where it is interest earning. So you move your money from the current account to a call deposit, negotiate a good rate for yourself, for the business, and then you're able to earn something. You could decide to put it in a money market fund, or you could even decide, if you have the money for a long period of time, to put it in a special fund and earn more. But now you have to think about your level of risk and ability to take risk. And so for business, if it's money for your day-to-day running, I would go with the shorter period opportunities. So call deposits, money market funds.
Quick liquidity.
Quick liquidity. A treasury bill is only if you know for a fact that you will only need your money after
a given period.
Yes, after a given period. Because treasury bills are 3 months, 6 months, 1 year.
Yeah. And even longer.
No, it's the 3 months, 6 months,
bonds.
1 year. Bonds are the ones that that are longer.
Okay. So what I'm also hearing about the security basket, the return is, it's not astronomical. So you're not going to get...
That's a great point.
Yeah.
Your goal is not returns. Your goal is protection. Yeah. What you're aiming for is protection. You want to make sure this money that I've left here, it is going to be available for me. That is your goal. And so if you make a return, it's a bonus. Of course, you want to maximize the return you can get, but within a certain level of safety. So your money market fund is fantastic for your security fund.
I get it.
So your emergency fund, money market fund works best. So now you look at, okay, what companies exist within the money market fund space and what are the returns they're giving, but then how big is their balance sheet? Now you look at what are the different factors I need to consider so that I ensure my money is safe and I can get it back as soon as possible and it's convenient for me to trade or transact with these people.
Okay.
Yeah.
Let's hear the next level.
So now that was the security level. So the next level is I want to beat inflation and I also want to make sure that even the markets, as they do this, like we saw with the stock market this year, I'm still okay. So there's an element of diversification, but then these are the assets that you would consider, okay? So treasury bonds fall under that. You have stocks or shares, and those stocks or shares can be from any country in the world. Then you have money market funds as well. And the reason I have money market funds there as well is because you must have liquidity. You always need money available to deploy because opportunities don't wait for you to be ready. So you also want to have some cash somewhere that is for flexibility. I'm thinking about where I'm going to invest. So you just keep putting money there so that when an opportunity arises, you can deploy. Let me give you an example. In Kenya, we have treasury bonds that are issued by the government. And they issue them usually about once a month. But sometimes most people want to invest in the infrastructure bond. A lot of times they want to invest in infrastructure bonds. But then they don't tell you in October 2026, there's going to be an infrastructure bond. Usually it's the government has decided the next issue is an infrastructure bond. It opens tomorrow, it closes in 2 weeks.
Whoa.
And so if you don't have money, what happens? You know what I mean? Or you find there's an offer that has been given that has come and I don't have the money. So like, recently there was a Safaricom bond that was on offer.
Yep.
If you hadn't heard about it, you don't have 6 months to plan and save for it. So you kind of need to have savings ready to deploy.
But those savings are also not idle money.
No, it's not idle money. It's in the money market fund, earning some interest. Right now, the money market fund rates are about 8 to about 10.5% on average. So, at least it's earning something fairly good, and then you can deploy it when the opportunity arises. So I said stocks or real estate. So real estate, and the real estate has a whole host of asset classes within real estate. Like there's all kinds of real estate opportunities we can consider, from things like Airbnbs, renting, putting together containers, subdividing, putting up, shops. There's all sorts of things you could do within real estate, but it's within, of course, your ability, cash-wise, and your understanding.
Okay.
So real estate is another one.
Is liquidity a factor in this second bucket?
No, so the choice within the second bucket of which one you go for is liquidity, your time horizon, and your level of risk. Yeah. So, like now I've said all these different things. Even within shares themselves, the choice of which stock I'm going to go for will be determined by my level of risk. I might be like, no, I don't want to go for growth companies. I want to go for companies that are stable, that will give me a dividend. Yeah. So then you choose one that is stable, that I know even if it's not going to go up in price significantly, I know that at the end of the year, I'll have a dividend. Or every 6 months, within the year, I know they're going to issue a dividend, and that's all I care about. They're high dividend paying, and that's what I want.
Okay.
So between bonds, equities, real estate, what else did I tell you? Special funds, fixed income funds, equity funds, because you can go into mutual funds, global and local, they fall under here. Now, how much money do you have? How much time do you have with it? How much risk are you able and willing to take are factors that then come in. And so it's important to have conversations with people who understand.
I'm realizing this.
Yeah. You can't just say, oh, yeah, I need something that will give me, let me look at the one that has the highest return. Because there's certain nuances that you need to be aware of as you make a decision.
Can I just say
sure.
this? This cannot simply be based on return.
No. Oh my gosh, return is not the first question. In fact, I find it interesting that usually people ask for details on return as the first thing.
What should we be asking? Things like the security. How stable, how safe is this?
How safe?
Okay.
How safe is it? Okay. How much am I likely to earn? Is important. Of course, return is extremely important, but it's not the only thing. How soon can I get my money out if I need it? Because it will determine whether I can do it or not. So, for instance, I was talking about the treasury bonds within this basket. Now, a treasury bond is issued for a number of years. Okay, so currently there's one on issue. I think it's about 12.2 years to maturity. And then I have money and I need it in a year. And I have no business getting into that bond. It could be the safest thing ever. But from a time horizon perspective, there's a mismatch between my need and this opportunity. So I should not get into the bond.
I get it.
Yeah.
And again, as somebody who's dabbled in land, the return on land can be amazing.
It can be, yeah.
But the liquidity of land, I've realized, again, this is depending on where you're buying. But Kenyans love land, and I know a bunch of our clients are in that Kenyan bracket. So land is amazing. However, if it is for the liquidity basis, that should be something that you factor in.
Yeah. So land actually also, real estate is part of that basket as well. Land is great, but I think you need to have a strategy. As you're buying the land, you need to know, as you're going in, what's my plan with this land? Am I buying it to subdivide, sell? Am I buying to build on it? What's my plan? So that you don't get disappointed. Because it can take a year, 3 years to sell a piece of land. So that then it's not where you're going to get money for an emergency when things happen.
Okay.
Yeah.
You're not looking at it as, again, I like the way you've really categorized them. Okay, the third one. So are we done with the second one?
Yeah, so I think I've given you quite a number of examples. So we're done with that one. And by the way, these are just examples. It doesn't mean that everyone should be looking at investing in all these different things. It's just these are the categories that, I mean, they all fall within that sort of category. The last one is your, I call it the aspirational basket. It's your dream. It's where you want to put money away that can give you an ability to generate good returns. So here, return is important. Okay. And risk is high. Now, the kind of examples would be things like crypto, things like currency trading, private equity.
Currency trading is high risk.
Very high risk. 80% of individuals who trade in currency trading make losses. Yeah, it's high risk. It's high risk. Currency trading, crypto, I talked about private equity, venture capital. So that's investing in other people's businesses. So Richie starts a business. He needs some capital. He comes to a friend and says, you just, please, I need to invest in my business. High risk, high risk. I'm selling shirts. I'm going to Turkey. So you give me chums, I go to Turkey. I'll pay you back in 3 months when I sell my t-shirts or my shirts. Yeah, high risk, high risk. But potentially very good returns. You could double your money in a year as an investor in that sort of thing.
Could.
You could also lose it.
I've not heard you mention betting in this.
Oh, betting is not an investment. It is nowhere near this. Excuse me. I am insulted. Betting. And you know, it's a crisis in Kenya, but it is
Reena,
not
I saw
an
the
investment.
amount that is bet a day, or is
It's
it?
insane. It's so sad.
It's in the, I mean, yearly it's in the billions.
Yeah. So the problem with betting, it's win or lose, eh? And then with betting, it's patapotea. You have no idea. There's no strategy. Okay, they say there's strategies, but the house always wins. So whatever strategy you can come up with, the house always wins. And there's algorithms. They know who you are. They know when you came last. They can make you win a little so that then you put in more and then they make you lose. Anyway, let me not go into that rabbit hole. Betting is not one of them.
Okay. So betting doesn't fall under your investment category?
No.
I know this may sound we're having fun saying this, but there are people who think betting is investment, and that's why I've brought it up.
Well, it is not.
Okay.
It is not, and I would highly recommend for those of you who are betting, please just start putting money aside in these boring things I'm talking about right now. You'll be happier for it later. Yeah. I've never met somebody who said, oh, my wealth is from betting. Oh my gosh. You show me one.
There are two. There are those guys who want
I don't know one.
296 million.
He's one in how many?
In hundreds of millions.
50 million Kenyans?
Yes.
No, maybe now just 2 in 50 million.
Yeah.
It's not, and how many have made losses and what amounts?
Yeah.
Yeah, so no.
Okay.
No.
So but there are high risk investments. When you say it's a high risk investment, what does that mean?
It means that I could lose my money, and a good chunk of my money.
Okay.
I could lose everything or I could lose some, but a good chunk of it.
Okay.
With these others, yes, they could potentially still be losses. So I could have my money in a bank account, for example, in a call account, my security basket, but the bank could go under. But what are the chances of that happening, right?
Yeah.
So the risk level, you'll notice as you go up the pyramid, the risk level increases. Yeah, and so does the return level, hopefully. Now, when you start using leverage, so borrowing money to invest, that also increases risk, and that takes you now to the top. So, for example, if you go for CFDs, CFDs are contracts for difference. Yeah, that's very high risk because you're using leverage. If I borrow to buy shares, now that moves your stocks investment from here to there. If you borrow a huge chunk of money, a huge percentage of your investment in real estate, for example, that takes you from here to here. So leverage changes things.
Okay. Because you're borrowing.
Because you're borrowing.
Okay.
Yeah, because you're borrowing. But yeah, so I think that's in a nutshell. So where do you begin? So back to your question in the beginning. You have to think through, what am I doing? What am I covered? So you don't have to have every basket covered before you move to the next one. That's not what I'm saying. But you need to have an emergency fund, at least. You need to have an emergency fund, and the level or amount in your emergency fund will depend on your personal circumstances. So I can't prescribe it's 100,000 or it's a million. It'll depend.
Yep.
You know, some of us are single, you just need 100K and you're good. Others have 5 children and are single parenting and you need a bit more. So it just depends. So once you've got your emergency fund in place, then you can start investing in things like shares or things like special funds and things like bonds and other things. But you need to have an emergency fund. You need to have healthcare covered. You need to have to have health insurance, and you need an emergency fund.
What's though the mentality of, Yani, I'm going to take this money, I'm going to give it to the health insurance company, but I'm not going to get sick. Angalau your pesa, that money, if I had taken it and put it in shares, even if I got sick, I would have just... I'm trying to change our psyche, because I've realized there's a psyche we have, myself included, when we think about investment, because for majority of us, nobody has sat down, talked to us, and walked this journey with us.
You know, the problem with investing, and this is what investing is, you're putting your money away in something, whether that something is a business, whether that something is shares, whether that something is a money market fund. You're putting your money away in something that should pay you back that money with a return within a time frame that you want. There's no guarantee that will happen. There's no guarantee you'll get the return you're looking for. There's no guarantee that this company you're putting your money in is going to survive the period that you're putting. There's no guarantee. I mean, life can happen. And so choosing...
we've seen banks go down.
Exactly. So choosing to put money away that you should be putting aside in your health insurance cover in an investment is taking extreme risk on yourself and on your life. It's not worth it. It's not worth it. In fact, I usually have, and this is something that I usually train people, we have different things that you need to think about given the different seasons of your life, right? So for those of you who have parents that are aging, for example, they need health cover. So that then also for you, you're not having to keep paying out this money every single month to buy medicine and to buy whatever. How can you cover yourself so that if they need to go for outpatient care, there's money already available from the insurance company. That prevents you from having to use your active income to keep giving them money and supporting them in that way.
I get it.
Yeah, so back to insurance, it is advisable and it is wisdom to have an insurance policy, even at the basic level.
Okay, so walk me in this journey, and then now I want to touch home. I want to come to Oak, where investors in Oak, people who are thinking about Oak, people who are in Oak, where do they fall in?
So,
and does it vary, or are we all standard under one high risk? What's
So for Oak, as an investment, would fall under the middle basket, right? But then within the middle basket, in the sense that it's going to help you to earn over and above the rate of inflation. Yeah, much more. In Kenya, average rate of inflation, in my view, is about 7%. Okay, so you've got 7% average long-term inflation. As long as you're earning more than that,
Okay.
you should be okay. But you want to earn more than that because there are some things that have much higher rate of inflation than others. So I think you need to earn more than 10% in this country to continue to sustain your standard of living. So are you going to earn more than 10%? Yes. Is there a level of risk? The answer is yes. So for you to invest in something like Oak Special Fund, one of the things you need to think about is how much time do I have with the money? So if you have money for 2 months and you need to pay for something, I'd say that is not the kind of client we want. Because you have to lock in your money for 6 months. But besides even just these 6 months, you need to have money available in your Oak investment for at least a year to 2 years to actually see the growth of your investment.
Okay, so let me ask this. Let's say I'm getting married, where it's December right now.
Okay.
29th. Let's say I'm getting married in April. My dad's just given me 4 million shillings and said, this is my gift for you. Are you saying that that person shouldn't bring that 4 million to Oak?
No, they should not.
Wow.
They should take it to a money market fund or a savings account and just keep it there because they cannot afford to lose a dime from that money. They can't. They need to keep adding to that money depending on how big they want the wedding. I'm like 4 million for a wedding. Wow. But yeah, they can't afford to lose it. And so they have to keep the money safely somewhere that will earn them a reasonable interest. And
they get it pulled out by a certain time.
For them, the goal is not interest. I mean, of course, they want to make some money, but that's not their goal. Their goal is to make sure the 4 million is available when they want it.
Okay. So why then do you talk about this? The Oak lock-in is 6 months. If you put in money today, you cannot touch it for 6 months.
Yeah.
Even if you top up, you cannot touch that top up for 6 months. Yeah. So why then do you not say put it in for 6 months? Why are you talking about 1 year, 2 years?
Because of the power of compounding.
Okay.
Of course, after 6 months, if you want to withdraw your money, by the way, please, you are welcome to. But for you to generate the most benefits from any investment, you want to keep it longer. Even with shares, if I invest in shares, I buy whatever stock it is I buy today, I'll benefit more from a longer term perspective. Yes, I can make money in 2 weeks. Yeah, I can. But those opportunities are not usually as frequent. You're better off taking a long-term strategy when it comes to certain investments, such as stocks, even special funds, mutual funds. You want to keep investing and keep investing and keep investing, and it just continues to grow and continues to grow. And the more that you keep investing and leave it for time, the power of compounding is magical, Richie. It's magical. Like, the longer your investment period, the more you're able to make some really, really amazing returns. And that's why we encourage clients. It's not that we want to hold their money all that time. It's just they will benefit more. And if you just do the numbers, you'll see.
Okay. Okay. That's I mean, it's clear. What else then should we know about this whole investment journey?
I think
or investment approach.
I think the main thing is you need to start. If it's an income you need, let's start with that income. Once we have the income, put aside some money. And it doesn't have to be a lot. As long as you're putting aside the money consistently. Have an emergency fund. Now, once your emergency fund is in place and you're consistently putting money aside, you'll be amazed how far you go. But then you also need a plan. Okay, so what's my plan? Am I getting married? Or am I buying a house? Am I buying a car? Or what big ticket items am I thinking about? Start thinking about those things. When are those things coming? Is it in 6 months? Is it in 3 months? So that then as you're making your investment decisions, it's in line with the plan that you have. And the last thing I have to say is that you must think about your investment plan as one whole strategy. So that then you're not listening to your friends in a certain place, having some nice drinks, and they say, oh, I've just done this, blah, blah, blah. And you're like, oh, really? How much did you make? Oh, for real? Let me put my money there. And then you go somewhere else, they say, oh, yeah, for real? Let me put my money. And so you find people have all these different investments. And I have made these mistakes, as I started when I told you. As we started, as I said, that I have made these mistakes myself, where I'm buying land here, buying land there, buying land there. Then I've got this, I've got the other. without looking at it as, okay, so what's my plan really? And what is the purpose for this? And what's the purpose for this? And what's the purpose for that? Because the moment I start looking at my things as one whole strategy, then I'll be a lot more methodical in the way that I make my investment decisions. I'll be able to say, you know what, that sounds really great, but it's not part of my plan. And it's not going to take me where I want to go. Right now, I notice the gap I have is in my security basket, or the gap I have is in making sure that I'm having my money work for me, or the gap I have is I need to take a bit more risk, and so I need to find other things. I don't want to have all my money in the money market funds. I have a lot of money. So when you know what you have and where it is, and you're looking at it as one whole strategy, then you're more strategic and long term in your thinking, and you do so much better, so much better.
Okay, I want to ask now this one, and this one is me being selfish as a father. So, I've got 2 girls. It's nice when you tell me 1-2 years. But in 1-2 years, let's say my youngest will be 9.
Okay.
At 9, I don't want her touching money. Like to pull it out. I'm like, if you're talking about this compounding works, would oak be a good option for me to consider if I'm saying, I want to open up for her today. She touches when she's 18. Not even 18, because 18 she's probably still young. Maybe hand it over when she's 25.
Hand it over. So first we'll need another separate conversation about that. But
yes,
let's just work with that. So at 25.
So that she at 25 doesn't have to ever think about rent as I work for rent. You get what I'm trying to say? So here is a portfolio or whatever that I'm building, topping up every month. Let's even put a monthly top up. Is oak a good consideration for that kind of investment?
So the answer is yes, but there's a but.
Okay, what's the but?
Don't put all your eggs in one basket. So there's several things that are going to happen for this 7-year-old. I'm guessing she's 7 right now, right?
Yeah.
So she's going to go to school. Is this money that you will need for her education, or this is money you want to have her given? Okay. Yeah. She might have an amazing talent. At the age of 12, you find out she needs to go to Switzerland, I don't know, to learn how to do, I don't know what. Maybe she's a gymnast who needs to go to, I don't know, the only coach available is in Finland. I don't know, right? So there's, life is not a straight line.
Yeah.
So let me first put it that way. And so you need to also, even in that circumstance, figure out, I need some money, safety net for this child. Am I getting an insurance policy for her? Or am I, so there's that. Then there's, what other investments can I get into? So that if this one doesn't work out as great as I anticipate, there's this other one that's available. So I'd say maybe you choose 2 things.
Okay.
So you could decide, maybe I want to get her an apartment so that when she's in university, that apartment is paying her rent. I don't know. I'm just saying. I want to buy her a bond so that then there's an income that is coming through whatever. So there's different things. So I wouldn't say just buy oak and only oak is the only solution for her. No. It is one of the options. And it can get her there for sure. However, I don't have a crystal ball to tell you we're going to do 20% every year until then. It's like this, as you've seen. And so sometimes we might do 13, sometimes we might do 25, sometimes we might do 15. And so because of that, I'd say find a way to also put in something else that can also do well for her. But also find something where she can also learn to be able to invest on her own. Wow. So when she's 25, you're not handing her cash. You're handing her perhaps a portfolio that she's already understood herself that she can continue to invest in.
I need a one-on-one coaching session.
So
I get it.
You get it?
I've understood it.
Yeah.
So explain then.
You see, like now stocks. I'm just like, oh my gosh, shoot. She's 18 years is a fantastic amount. So which company can we invest in? She's young, so she can take that kind of risk as well. So now let's do this together. So there's the opportunity also for her to learn as you're investing. It's not just about the money.
It's not just handing over a portfolio.
It's not just handing over
cash.
Chums.
Yeah.
Yeah.
But isn't it nice? Imagine.
No,
if-
it would be fantastic.
Yes.
And maybe even have separate money that you can do the teaching with and then this other money. But can Oak do it? Yes.
Okay.
Oak can do it. How much do you want to put aside? Maybe you put in 500,000. And every month you put aside 50K.
I like what you're saying. So what you're saying is, don't go 100% into this thing. So, for example, this two have no correlation. Her school fees and how she gets her education currently, and this Oak thing. So, it's not that I'm taking the school fees money for this Oak thing. Does that make sense?
Yeah.
So, but I like how you've said it. You said, think of it as a percentage. That's what I'm hearing. When you're basically saying diversify. Diversify with the understanding of safety. You have even brought in this element of also educate her about money. And also, yes, you're going to give her cash, but even that cash, she needs to understand how to manage it. So,
Can I show you the map? Can I have my laptop so that I can show you the map?
yes. And while your laptop comes, let me ask the question. For you, if you can share, and to the level of sharing, because this is a conversation that we're having. You have children. What does your diversification look like, just for an understanding?
So for me, I've not, well, let me say we, because I'm not alone. I have a husband. We've talked about this in so many different ways. Do we invest in for each person on their own? And we didn't do it that way. We have our investments, and they will end up inheriting them, whatever is left, right? But for each of them, we want them to participate in the process of investing. So for example, my daughter has stocks. And so it's like, okay, do you know what this is? We've received a dividend check. Do you know what this means? And I have to keep repeating. It means this is what shares are.
Oh, wow.
Okay, this is what she was, I think, 12 or 13 when we got the shares. And so with the others, it's the same, and that's what's going to happen. So with my 10-year-old, there's one time, I think she was 9, and she came and she said, Mom, I want to be rich. I want to be rich. What do I do? And we sat down, and when I explained, okay, so wait, so I have this 10,000. So if we put it here, when can I double? I'm like, double? Unless now we start doing other work. Yeah, I think at that time she was making cookies and I don't know what. So she got so discouraged. It was so funny. She got so discouraged about the reality of what it takes to make money. She was just like, I'll get back to you, I'm all right. So it's important that I don't just have a pot of money available for this child. At 25, she just gets a pot of money. She will not do what needs to be done at that point in time. And so for us, we are carrying out our investments, and we have our investments for their education. We have the investments for the different things, our retirement and things like that. At the time that is right, they will get the inheritance. But by that time, they will have had experience in understanding this is what it is to have a bank account. This is what it is to have stocks. This is what a money market fund is, and have had the experience. So that by the time they're like 18, 19, they know. And I'm not giving them cash at that point in time. There's an interesting book I read called Wealth in Families. And it's by a professor in Harvard. And this professor, first, I don't know how he ended up here, but he advises ultra high net worth individuals and families in the US. And he said the biggest problem for ultra high net worth people is transferring wealth in a manner that does not destroy children, but it also in a manner that carries through the family values and the family heritage, so that then you don't transfer money and they lose drive, they lose purpose, they lose a sense of who they are, because they're, what am I working hard for anyway? We own the whole of
life.
Nairobi, and you know. So it was so interesting to see that he advises parents to give money to children in phases. And part of that process is also making sure that they're educated. So financial literacy is very important. But even as the financial literacy happens, you don't give all the money, pop. It's at 25, I give you a little, first I observe. Okay, where are the gaps? Da, da, da. And even as I do that, explaining stories. So let's say they're called the Njoroges. Who are the Njoroges? What do the Njoroges believe? What did the great-great-grandfather within the Njoroges do? And what is your identity as a Njoroge? Who do the Njoroges impact in society? allowing children also to explore their own passionate pursuits, their own purpose as individuals, their own passion. Because you could have a musician, you could have a doctor, you could have a lawyer, and you can, of course, pursue those. But even as you pursue those, the Njoroges, this is how they live life. These are our family values. This is who we impact. This is how we... And he has found that the families that are able to explain family history, explain our culture, explain who we are and what we're about and the causes that we're about, explain financial literacy, that they have a lot more success in being able to transfer wealth. And so that got me thinking. I'm like, there's something about allowing children as they go into their 20s and their 30s to struggle a little to figure out, how do I make money? How is money actually made? How is money lost? And what do you do when you lose money? So that then you're not front loading the inheritance. So there are some who give inheritance up front and they're like, okay, that one, it belongs to you, that one, it belongs to you. Okay, fine. But there's a certain laziness that comes and a lack of hunger that sets in when you don't allow children to be hungry and to lack.
I've had a lot of people say, hey, I wake up because I'm running away from poverty, because I've tasted it. So it sort of brings in the grit, the grind, the hard work. Okay, let me move.
Sorry, I went into a rabbit hole.
No. It was beautiful rabbit hole. As you said, this is just an educational video that we are doing. What about then me? Let's say I'm like, okay, fine. Let me put in money from the long term. I'm already an Oak client.
Wait, so are we still dealing with this 7-year-old?
Okay, let's first answer this. No, but your rabbit hole answered it.
Did it?
But
Okay.
yes, no, but show what the maths would look like.
Okay, so let's just I'm just
Let's put 500,000 Kenya shillings.
Okay. For how long? That's 18 years, I think.
No,
How many years?
Let's say now, it's 18 years.
Okay, so at a return of 15, 17, 12, how much return? 17. Compounding
No, so we're putting it Oak.
Okay, so if it's Oak, we can say 17.
Yeah, because Oak targets 20.
We target 20. So let's put it at 17.
Okay.
Compounding annually, any additional contributions?
Yeah, 50,000 a month.
50K every month.
Every month.
Okay.
First of all, what if I don't put? Let's start there.
Okay, so no contribution.
Zero contribution. I don't put any other money.
So with zero contribution, in 18 years, your daughter will have 8.4 million when she's 25.
I've just put the 500
Just
Gs and I've
500
gone.
Gs and you've
And I'm like, by the way, done.
Done.
25, she's taken
8.4 million.
Okay.
So now you're adding.
Let's do 50K.
Okay. So let's add 50K. So if you add 50K, 18 years, a return of 17%, compounding annually, your daughter will have 68 million shillings.
Reena. Keep your stocks. Keep your shares. No.
So let's just say you do a combination. So let's say you don't put in Oak, you put in Oak and maybe some in a money market fund. And so let's average the return, okay? So let's make the return 13%.
Yeah. You see, why do we get excited with returns? Because now...
No, let's just put 13.
Okay.
Let's see. With no contribution over the 18 years, she'll have 4.5 million, which is still good.
Yeah, because I've done nothing.
Yes. You've just put 500,000. You're earning 13%, right? This is net. 4.5 million. So let's say you put in the 50K every single month. She'll have 43.7 million at 25.
Hi.
She'll never need to work a day in her life. She can put this 43 million into a deferred annuity and it will pay her a staggering amount of money when she retires. But anyway, those are details.
Okay. What I think you have beautifully explained there is compounding.
Yeah.
So let's put a million and let's say now, remove my daughter.
Okay.
We're doing this for myself.
All right, for yourself now.
I have 1 million shillings,
Okay.
and I'm going to put in 50,000 every day from 2026,
Okay.
2036.
10 years.
I'm taking it out,
Okay.
and I'm retiring.
So in 10 years, and are you putting it, okay, what rate should we approximate?
2017.
Okay. In 10 years, you will have 19.2 million.
Okay, and how much would I have put in?
You will have contributed 6 million shillings. Yes, 6 million shillings.
Or the 1 million and then
The actual contributions, yeah, it's 6 million.
Yes. Okay. So all of this is to emphasize the power of compounding and also to emphasize the power of time. So given that Faida doesn't go down, or Oak doesn't, as a company, go down,
So first, we don't hold your money, eh?
Yeah, so even if you go down,
Listen,
INM will pay me back.
Not even that. The unit holders own Oak. So the unit holders can actually appoint a different fund manager. Faida is only a fund manager. They can have a meeting with the trustee, Cooperative Bank, and appoint a different fund manager to manage Oak Special Fund.
Wow.
Yeah.
This I'm learning today.
Yeah.
So if Faida Investment Bank, because I really like how you say, we need to separate the two. Faida Investment Bank, the money doesn't sit in account that says Faida Investment Bank. So if Faida Investment Bank was to go down, all the people who have invested in Oak Special Fund.
A meeting will be called that Faida, God forbid, this has happened. A meeting would be called with the trustee, perhaps even the regulator, and they would appoint another fund manager to then manage the fund. The fund would never go under.
Wow. Oh.
That's how the system works. That's the structure that has been set by the regulator.
Okay.
We have a custodian who holds the assets. We have a trustee who represents every unit holder. Everyone who has invested in the fund is represented by the trustee. The trustee checks, are we investing in where we've said we're investing? Did we make the returns we said we're making? They are representatives of the unit holders, and they hold us to account.
Reena?
And then we have a regulator that makes sure that every 15th of the month, 15th of the month, we are sending our accounts, our reports, and so on.
Okay, so first of all, I'm really excited that you've brought this conversation. In this series where we're having educational conversations, what we're going to do is actually figure out a way to bring the regulator here.
That's easy.
Well, you should know people.
That's easy.
Okay, I'm really serious.
Yeah.
Can we have this educational conversation with a representative from Capital Markets Authority? We can.
Yeah.
So that the unit trust holders, the clients of Faida Investment Bank and Oak Special Fund, can then get to understand more about the regulation. Because our values are three things. Trust is like we trust that nothing is happening behind the scenes. Transparency, and also now the tactfulness. We've been having a lot of conversations around tactfulness, where we're investing, returns, fund sheet performance, the fund performance fact sheets, and we're going to continue doing that. But I want us to now add more into the transparency and the trust. Do I have permission?
We do. We might have to go to them.
Yeah, no problem. Cameras move. Cameras move.
That works.
Okay. What if somebody has watched this? And they would like to join Oak Special Fund?
Yeah.
How do they go about it?
Very simple. There's a number on the screen. Just send a WhatsApp message to that number. You can also send an email to the email shown. You could also just go onto our website, and the application process is there. We also have an app. If you go to, I think it's oak.africa. I believe we can check that in case I'm wrong. You can download the app or go onto our
Play Store.
To the Play Store.
Yes.
Play Store, App Store, and download the app.
Yes. Lastly, Jilipe. It's the beginning of the year. I know, and we're going to be talking a lot about Jilipe because we've just seen the magic of compounding.
Yeah.
We've just seen the magic of
amazing.
Compounding. And I feel like it's our duty to remind people, guys, this is not just, it's about you. It's about enjoying the benefits of compounding. It's about how do we get you to the goal that you're going to get to. What could you say then to our existing clients about Jilipe? Okay.
So for non-English speaking, non-Kiswahili speaking people, Jilipe is really a Swahili translation of pay yourself first. let me tell you guys, if you can pay yourself first, you just decide, every time I get an income of whatever amount, my first thing is nijilipe. You will be amazed how you'll grow, because you'll find, first of all, I began to realize we have a lot of access to money as individuals. It's your birthday, someone has sent you some money, a client is happy with you, you've gotten a tip, maybe you're a waiter. You know, there's all this money that you get and you have access to in different ways. If you decide every amount of money I receive, I put it aside, you'll be so much happier for it. We demonstrated the 500,000 with zero contributions. Now those contributions, that's Jilipe. Those contributions of 50,000, if we remove them, 500,000 in 18 years ended up being 6.5 million. When you add the 50,000s over 18 years, it became 64 million shillings. The difference is shocking, especially over a long period of time. So failure to Jilipa, you miss out on the full power of compounding. I mean, of course, the power of compounding is still there, but the moment you keep contributing, you get towards financial freedom a lot faster when you do that. The consistent contributions.
I love it. I love it.
So even for Oak clients, actually, let me just say this. If you can find a way to keep contributing into your account, so let's say you've decided I'm doing Oak for the next 5 years. In fact, there's somebody who I spoke to and she's using Oak to build a house in a number of years from now. And I'm like, it's brilliant. And so if you can keep contributing towards that goal, you get there so much faster.
And one of the things that I'd also say is contribute at source before you get the money flows. There's always needs with money. So the reason why you're talking about how much money comes, if we look at our Safaricom and M-Pesa app, how much money comes in and out, if you kill it at source, or if you send it somewhere out at source, aka standing orders, it actually, you don't get to see it. Yeah.
Standing orders are great, but not everyone can do them, especially those who are in the gig economy, so it might be challenging. But if you can do standing orders, please, they're fantastic.
Yeah, but the gig economy, it's mindset. It's
mindset?
Yeah, it's hold on first, let me jilipe. Because some people have gotten that mindset with tithe. Now get that mindset with paying yourself also.
Awesome.
Okay, Reena, I want to say thank you so much.
You're welcome.
I know I bombarded you on the 29th of December while a lot of people are chilling. But thank you so much for the conversations. We're going to be having a lot more conversations, guys. We're going to be shooting a lot more videos this year around various things. We're going to show you the office. That's another different place that people can come and see. We have maintained our other offices, haven't we?
We have.
Okay. So if you want to meet us in town, Windsor office?
So the Windsor office is largely for shares or bonds.
But can somebody walk in?
Yeah, anytime. Windsor House, first floor. We have Crawford Business Park on ground floor. That's on State House Road. Crawford Business Park on ground floor. It's right opposite State House Girls High School. And then Oak Special Fund is at 9 Riverside Drive on 4th floor.
And the details for calling, if you'd like to get in touch with the members of the Oak team, just send an email, send a WhatsApp message, or you can call the number that is on your screen. For us, we just want to say Happy New Year. And if you're watching this in the new year, still Happy New Year. It's Happy New Year until February.
No, until the 15th of January. Happy New Year, guys.